the managerial accounting, their users are internal or insiders, like managers, employees, CEOs, right? And how they can, where they can get the information? They can get the information from budgets, forecasts, projections, right? So there's a difference between these two, and also the treatment for these two are also different. So what we learn in our financial accounting is not necessarily the same that we are learning in managerial accounting. Managerial accounting is also called cost accounting, which is a totally different stuff, right? So don't confuse the financial accounting with the managerial accounting. Managerial accounting, as its name suggests, these are for managers, and managers are insiders who work for the company. So they gather the accounting information for themselves so that they can plan better, right? They can employ that much person, or they can buy that much material, and they can make that much units of products so that they can sell and get maximum profit. When they get maximum profit, then they make financial statement and publish to the outsiders. And outsiders will see that, okay, this company is having a good profit, so we should invest in that company. We should buy the shares of that company, right? Understand the difference between financial accounting and managerial accounting? Class?
Yes.
Good. If you understand that, so we are going to the basically introduction of the business stuff.
Je suis pas d'accord avec ça.
Florian, please turn off your mic. Okay. Organizing a business. So up till now, what we have studied, the accounting is the language of the business, and then we talk about who uses the accounting information, and also the categories of accounting, the types of accounting. There are two types of accounting: financial accounting and managerial accounting. So now the form of the business. So there are 4 forms of the business. So you already learned in Introduction to Business. So I'm not going to be spending too much time here. Only the relevant stuff we will be discussing. So number 1 is the proprietorship. Number 2, partnership. Number 3, limited liability company. We also call this LLC. Number 4, corporation. My bad. Right? So what are the characteristics of proprietorship? The owners. So we have 1 owner in proprietorship. We have partners, 2 or more than 2. The LLC, we don't call the partner, we call members. It can be 1 or more than 1. The corporation, we call this owners or shareholders. It can be 1 or can be more than 1. The personal liability of owners for the business debt. In proprietorship, if business make a loss, it means the owner make a loss. It means they are personally liable. Because business and you, they are the same. If a noodle shop person make a loss, it means the loss can be fulfilled from his own property. Maybe his bike can be sold, his house can be sold to carry out, to fulfill his obligation or fulfill the loss. Partners, general partners, wow. Here. The general partners are personally liable, but limited partners are not. It means there are 2 categories of partnership. Number 1 is only partnership, which is general. What's happening? Okay. I need to go back. There we go. Sorry. So general partners, I mean there are two kinds of partnership we were discussing. Number 1 is general. Number 2 is partnership with limited liability. So in general partnership, if there is a loss can be covered by your personal properties. right? Plus, let me give you the example, okay? So I will be turning off my video and I need to write it down, so please be patient. Okay guys, so we were talking about the general and limited partners. Here we go. For example, if the partnership make a loss of 100,000 and your partnership bought like 50%, it means 50,000 loss is going to be divided among the two partners. So there are two partners, Mr. A, Mr. B. But Mr. A has his personal wealth of like 500,000. Mr. B has his personal wealth of only 20,000. Or property. So Mr. A can bear the loss, yes. His property, personal property or personal wealth going to be 450,000. But can Mr. B, handle the loss? No way. Still, the partnership has a loss of this 30,000. Since it is general partnership, so this loss will be transferred to Mr. A. Sorry about my $30,000 and Mr. A property, personal property would be 4,20,000, right? So this is, it means even though in partners, even if you divide the loss with 50-50, even then this is not guaranteed that you cannot get more than 50% loss. Here Mr. A got more than 50% loss. Why? Because this is not limited liability. If this is limited liability, right, then Mr. A is not liable to pay Mr. B's loss. And Mr. B is also not liable to pay from his own pocket. It means Mr. A wealth would remain 500,000 and Mr. B wealth remain 20,000. So whatever the business make a loss, that loss would not be transferred to their personal wealth. That is the meaning of limited liability. Let's go back to our slide over there. Right? Partners are personally liable, but limited partners, they are not liable. If all the partners are not liable, then if the business make a loss, that loss is not transferred to their personal properties. In LLC, the name applies limited liability company. It means whatever the company make a loss, their personal properties are not involved. In corporation, this is also not liable. The stockholder, the shareholder, they are not liable from their personal property. So all things we already have discussed here. So I'm just going to read that. So proprietorship, single owner, tend to be have small stores, solo providers, similar like singers or musicians, right? Barbershop, hair salon, makeup salon, this kind of stuff. Doctors. So proprietor is personally liable. So business records should not include the proprietor's personal finances. So when you report your financial position, so for reporting is that you only report the business. You don't report, for example, if you are a doctor, you open a clinic, so you just publish the report of the clinic, not your own household. Okay, I have this much car, I have Bugatti, I have Lamborghini, I have Apple Watch, I have gold watch, I have Rolex. No, you only publish the report according to the activities of the clinic, right? But if clinic make a loss, your personal properties, those gold watches, Lamborghini, they can also be sold out to fulfill the loss. Partnership, two or more parties. In partnership, the owners are called co-owners. Okay, so you can have minimum two co-owners, and you can have as much as more than 50 or 3, 4, 5, 6, whatsoever. So income and losses flow through the partners, means income is added to the partner's income. So it means if a business make a profit, it means you make a profit. If a business make an income, it means the partner make an income. That's it. So general partnerships have mutual agency and unlimited liability. Like I told you, mutual agency like a 50-50 partnership, but still, if somebody cannot fulfill the 50%, so that 50% will be divided among other partners. So the examples are oil exploration, real estate, professional services firm. If you have more than 2 doctors operating the clinic, that become partnership. So a limited liability partnership lessens the risk to the partners. Okay, if one partner says, I am going to be in that partnership as a limited partner, then his property will not be involved. The benefit of this one is that, so you are not liable to pay the mistakes of other partners, right? If somebody else is making mistake, so that your properties are not at risk of his mistakes. Limited liability company, so the business, not the owner, is liable for the company's debt. It means this is limited liability. It means loss is not going to be transferred to your own properties. So you can have one or many owners. We call this members. So all the members have limited liability. So income flows through the member. It means if the business make a profit, it means you make a profit. So you will be taxed only according to your single individual tax system. For example, 20%. Right? If